Welcome everyone. Today's conversation is about investing, and we have a lovely panel today. We've got Scott, Alberto, Kapila, and Thorne. You guys can wave so we know who the panelists are. All right, and I'm the moderator. My name's Aron Starosta. My background is in early stage investing, sub $1 million revenue companies. And I am also known for building accelerators. I run and direct the Launch Lane Accelerator in Philadelphia, and about 29 others have built over the last decade or so. I've been involved in the investing space for about 28 years. So I'm going to ask each of our folks really just to say their name, who they're associated with, and what stage investing they do, because I don't think we need to do too deep a background on each of us. You just need to know kind of what our space is and what our stage is, and then we can just jump right into the questions and conversation if that's okay. Does that sound like a reasonable starting spot?
Sure.
All right, so Scott, why don't we run with you, since on my screen you're at the top.
All right, I'm Scott Fishman. I'm here representing Robinhood Ventures, which is one of the largest angel investment groups in the region. We invest basically seed stage, early stage companies. 250 to 500 is a typical initial investment.
250 to 500, all right. And about how many investments per year does Robinhood do-ish?
It really varies. Between new and follow-on, it's probably, I don't know, between 8 and a dozen.
All right. Thorne, why don't we go with you next? I know you're not strictly life sciences, but you do some life science, and really you're a tech guy, but maybe you can give us a little more background.
Sure. The Slater Technology Fund invests in seed, pre-seed, and sometimes we follow on into Series A deals, but our roots are in seed stage.
All right. And so what's your sweet spot for numbers in a range?
I'd say $200,000 to $350,000 is a good first check.
All right. And how long have you guys been operating?
20 years.
Okay. And Kapila, I apologize because we made you do your hair for this. Yesterday we met for a run through, and she's complaining that she's going to have to look nice for this. And she clearly looks nice. So.
I actually had to go brush my hair out just for this. So I'm Kapila. I'm from New Spring Capital. We are based here in the Philly area. We like to think of ourselves as a growth stage investor. I'm a partner with the healthcare fund, and our typical check size is, I think the smallest check size is about 5 million. And we're looking for companies that have, 10 million to 50 million of revenue. It's hard for us to go below 10 million, but we will if there are compelling reasons to do so.
Yeah, and thank you. And I forgot to say, we tend to invest in the $50,000 to $100,000 range, but somewhere between 25 and 50 is probably the sweet spot. So we really deal, our investing is really with early stage prototype and focus on commercialization. All right, next we have Alberto, who is joining us from hopefully sunny Miami. Is that right? Or Fort Lauderdale or Miami?
I'm in Chicago right now, but yeah.
Well, that is absolutely not where I expected you to be. Why did I think Miami?
Because I'm based in Miami.
Okay, thank you. Okay, I was worried that I got crazy. How did you get to Chicago in one day?
Yeah, there's airplanes, early flight, masks. Yeah. I'm Roberto. I'm with Sano Invest. It's a first year fund one. It's a $10 million fund. We're doing $2 million ticket sizes, late seed, early A, and preparation for growth capital for healthcare companies, primarily for a primary care market. So we don't do bio, we don't do pharma. So it's mostly screening devices, softwares.
And did you give your investment range? I may have missed it.
Yeah, we do. Usually our ticket size are $2 million. That's what we're in.
And you're a relatively new fund, right? Year old or something?
Yeah, that's fund one for us.
Fund one. Well, This is an exciting time. So one of the things we also promised to do is not talk about COVID today. We feel like there's a lot of people out there talking about that for some reason, but we also feel like there's a lot of startups out there who are doing stuff in this environment who have been forgotten about, maybe temporarily, for good reasons, but maybe temporarily. But it doesn't mean that their doors are closed, their operations have ceased, or their need to grow and be successful startups has changed. So because of that, we want to try and focus on them and the work that they're doing. And so the best way we can do that is sort of talk about investment strategies and where you can find folks in this place, how you can approach them, things to say, things not to say, and the sort of things that our folks on the panel are looking for when they talk to somebody like you. So maybe that would be the first step in this conversation, would be sort of a general talking to or discovery of where we might be able to run into a Scott Fishman or a Kapila, where we might see a Thorne or a Roberto. Like if we were to go out to the wild, if we were to go to events, if we were trying to go to someplace to meet people like this to talk about investing, where would we find you? Where, you know, what's the best way to run into you? Is it through an introduction, or do you go to events? Maybe you could start and just sort of talk about how you go and look for opportunities. Again, I'll start with you, Scott.
Okay, that's what I get for being at the top of the screen.
That's exactly right.
Teach me to log in early. You know, we attend events in the area, packed, and some of our members go to ACS and so forth. But really, I think as with any firm that's in either the early stage or, you know, or growth phase, where a lot of it is introduction. A lot of it is warm introduction, networking. The process for Robinhood is simply through the online portal to apply, but it's obviously a great help if you already have made a connection with somebody who can introduce you to the group.
So you're an established investor who's been around for a long time with, you know, a long history behind you. Alberto, you've got a new fund. You know, how do you do this? Do you follow the same prescription, or do you have a different way of doing things because maybe you're younger?
No, identical prescription. Really, referrals. We network a lot with early stage investors, and then we do attend to Venture Cafe in Miami. So you'll find me there.
Kapila, Thorne, do you guys do anything different?
I hang out at a lot of universities. I like to walk the halls at places like Brown University. You know, there's a whole bunch of professors who do groundbreaking work based on federal grants. So a lot of the hard technologies and 5 years hence solutions you'll find around universities.
Cool.
So I think our process is slightly different in that you know, we are a later stage investor from all of you. So, you know, referral sources, like Scott said, we have great networks with early stage investors. And also because we are a well-established firm, we also have a very strong outreach program. So we have people, you know, so for example, within the healthcare fund, we develop, you know, if we have developed an investment thesis around a particular sector or a subsector, then all of us will be doing outreach to companies in our network and basically saying, hey guys, we're really interested in this. We're A, trying to educate ourselves. B, if you have any companies, then let us know about it. And a lot of that referral sources are earlier stage investors. So we do both outreach to companies as well as to other earlier stage investors.
So you mentioned something about investment thesis, and I want to come back to that because it seems like a magical phrase. But before we jump into that, I wanted to, you know, sort of comment on the fact that you guys are talking about sort of active and passive. One of the things that I've always wondered is that, you know, when you do things by referral, that indicates that you trust other people to, you know, do the due diligence for you and do the outreach for you and do the background and work for you. And when you do things through more of an active phase where you have a thesis and you look for things that are specific to your thesis and the things that you're interested in, that probably strikes me as it would probably be more fruitful. But it sounds like a number of you are, a couple of you are more passive and a couple of you more active. And I'm interested in sort of with the referral methodology that maybe Alberto, that you're talking about. How does that work out for you? What percentage of the referrals that you get do you feel are in your sweet spot, and you know which ones are, you know, just noise?
So I would say pretty much 80% of all the deals that we looked were through referrals, but we still we go through all the diligence. So most of the time, even though, some of the firms would consider themselves, ready for a Series A, for us, still not there. For instance, they weren't able to get an FDA clearance, or their pivotal studies are just not there yet. We're not satisfied with the data. So the way we do it is that we have a network of, kind of partners. So in health systems, radiology centers, depending on what the target will look like. And then we bring in that expert and we'll do the diligence, bottoms up and make a decision. So referrals is good, but we'll still do all the diligence, if that makes sense to you.
You said 80%. What are the other 20%?
I just scrapped the internet. Because
okay.
It's very complicated to, because and on my stage where I do kind of require that you're almost ready for FDA clearance or already have a FDA clearance, majority of the devices for screening, for instance, call it like diabetes, most of them would be already backed by a big pharmaceutical, like, think like Roche just came out with this 15-second test for type 1 diabetes. So most of them, they would go through the normal process, which is that 3-year game plan to get approval from, Medicare and get, the CPT code, whatever. So I have to diligently go in and pitch them, hey, I'm really interested in this, and I think I could add a lot of value. So we buy an equity part on, on that product, and we take it to the market. So it's a little bit more, it's a little different. So we're more of like an active investor, if you would say.
And I just want to comment on something they said earlier, which is, sort of a referral doesn't in any way obviate the need for due diligence. I agree with Alberto and probably everybody else on that. A referral simply means that somebody knows you well enough to know that you're worth talking to, that you're worth getting an introduction to be screened for the possibility of making a pitch. We have the advantage being a large group. It's not a fund, and when we do invest, it's on an individual basis. We form an LP, and whomever is involved in the investment is part of that LP. But we have almost 60 people, so we have an enormous amount of domain expertise across quite a number of areas, whether it's life sciences or IT or social media or whatever it is. And there's a great reliance on the expertise of the people in the group, such that if something is brought to our attention for screening, we already know that it's worth taking at least a look at.
So I heard Alberto say things like he was interested in companies that are FDA ready and that had relationships with pharma companies. That sounds sort of like an investment thesis to me. Maybe Thorne, and I know Kapila talked about an investment thesis, but Thorne, do you have an investment thesis? Do you have something that you use as sort of a Bible for decision-making when you look at companies? So
I would say those are two different things. So the investment thesis idea is something that super smart people like Kapila do because they're in a field and they've seen a whole bunch of things, or maybe they're pretty sure they want to have an investment in one area so they don't miss that one area. And I think that that's a brilliant way that some of the smartest people do it. I would say that I'm a little more opportunistic for a couple of different reasons. Some of the best investments I've ever made come out of left field. And I would say that some of the investments that are differentiated from others come out of left field. So currently my most valuable investment is from an entrepreneur who came to me and said, I have a way to make to transport electricity kind of like internet protocol, so that when you touch the electricity, it doesn't kill you, it just disappears. So I would never have made that an investment thesis. I just never would have looked for disappearing electricity. Now, when I happen to know the entrepreneur and had invested in his things before, and the notion of power following internet protocol, that's a kind of a nice metaphor. So, but I never would have gone after that. So I think there is a place for serendipity and for finding things that are a bit wacky. And frankly, I trust entrepreneurs to be exploring things, at least I hope that the entrepreneurs I hang out with would be exploring things that I couldn't think of. So that's not to say that the thesis-driven investments, that's especially important if you're going deep in one area. But I would say there's something to be said for serendipity.
So Scott, you're a conglomerate, a group of,
something I've never been called before.
Yeah, of angels, right? You're a plethora of angels. I'm looking for the right word here.
Yeah, it's like a gaggle of geese. Yeah.
Gaggle of geese, right? And so I'm imagining that everybody in an angel group such as yours, especially a big one like that, has a lot of different theses for how they invest. And so, in a sense, I'd be curious as to understand how that would work. When you approach an angel group, is it that everybody collaborates and makes a decision together as a group and they vote yay and nay? Or is it that individual angels decide to do one deal and others may not because it fits with what they think is a good deal or not? Or how does it generally work with an angel group versus, and I'm going to go to you next, Kapila, to say how's it go with a more traditional investment group?
Well, just from a nuts and bolts standpoint, there's a screening process. There's more than one screening committee, depending on whether it's life sciences or it's material science, whatever. But that screening committee has particular domain expertise and will either advance or not advance something that comes in as an application. If it's advanced, then it may find a spot in the queue for our agenda for to pitch. We have a meeting every month. That's the nuts and bolts of it. Once the pitch is done, we make a decision as to whether to go into formal due diligence, which is a 2 or 3 month process. And at the end of that due diligence, a presentation is made to the entire group by the people on the due diligence committee and individuals in the entire group. We recently had an investment with about 40 people involved in it. We have other investments that have 6 or 8 people involved in them to form the LP. I want to just really quickly, though, touch on the idea of the investment thesis, because there's a continuum of different interests that you really see evident in a group as large as ours. So you have people who are just, particularly intrigued by deals. They love the deal aspect of it. You have people who are more on the other end of the spectrum, myself included, where I'm really interested in the clinical impact of a particular technology. And then you have everybody else who's sort of in the middle. I can say, though, that I don't think there's a single person in our group who is there, just in pursuit of return. There's obviously, I think anybody in early stage investing in any aspect of investing has an intellectual curiosity about the companies that they're looking at.
All right. And Kapila, Thorne, go ahead.
Can I add another type?
Yeah, you may.
So we early stage people, I would say another type of deal that is successful is just the completely electric founder. And you meet this person and you think, geez, I may not even like the thing you're doing right now, but gosh, I'd like to stay in touch because I think this person's going to be successful almost at anything they do. Some people are just so dynamic and energetic and Pied Piper that you just want to be around them.
Those can also be the spectacular failures.
So can the 10-time exit guy. So we've been in both of those, right? So Kapila, get back to you just to talk to you. How do you differ from an angel group?
So we're a well-established fund. So we actually raise money from institutional LPs. Although I have to say we do have family offices and high net worth individuals in our fund as LPs. And then we have probably a third of our capital comes from what I would call healthcare corporations. So we find those relationships to be extremely helpful when it comes to diligence. But you know, at the end of the day, I'm going to sort of marry what both Scott and Thorne said, in that I would rather invest in a B grade idea with an A grade team than the other way around. Because at the end of the day, it's the people. You have to trust your team, your management team, to, you know, to be able to take that concept, that idea from concept to fruition, and, you know, and drive it beyond. And, you know, everybody gets sideswiped. We've all gotten sideswiped this past couple of weeks, but the question is your team flexible enough, smart enough to kind of, you know, work through various different environments? And at the end of the day, this is a people game, and we are investing behind people. So it could be the most brilliant idea of all. If the CEO and the COO and whoever else is going to be involved in executing the plan is not compelling, we'll probably not invest behind them. But to go back to your original question, Aron, we probably see in our healthcare fund, and probably across all our sister funds also, probably see somewhere between 800 to 1,000 deals per year. And we're probably only, in our healthcare fund, we only do about—
That's a lot.
Yeah,
So
it is a lot.
how do you track all of those?
So we use typical tracking software, you know, CRM software, to track all of those. And many times what's happened is that we'll see companies that are way too early for us, but we like the sector that they're in. And in which case we'll track them, and we'll make sure we stay in touch with them on a yearly basis. We'll invite them to stay in touch with us and build a relationship, so that by the time they get to a size and scale that fits what our criteria are, we've already built a bit of a relationship, and then we'll dig in deep and do diligence. Diligence is always needed.
So Scott was talking about, you know, the diligence taking about 3 months, which, gosh, that seems like a long time. I mean, how long does your diligence take?
Yeah, I would say typically we do a deal. I think by the time we get a signed term sheet to closing a deal, it's 45 to 60 days. But sometimes, you know, we've done a ton of diligence around the marketplace and the, you know, the actual company ahead of issuing a term sheet. So it's unfair to say that all diligence gets done post term sheet. We'll do some work before, and then we'll really dig in and start spending money on diligence after.
Got it. So Alberto, how long does your due diligence take?
3 months.
Thorne?
You know, I would love to say it was as fast as 3 months, but it takes longer. I just, you know, it's easier to do than it is to undo. So careful.
Well, you know, I tell our companies typically that they're going to need at least a year of effort before they can close a round of investment, and
Right.
so that's, you know, that's part of the process on the other end, right? It's a long time to meet you. It's a long time to go through the initial handshakes and the introductions, even if it's a warm introduction. And then once you're in there, there's a process to review the companies and you know, decide who to invest in or who not to. I say that.
Yeah, go ahead.
Please.
No, I just want to jump into something before we move on to a different area, and I want to pick up something Kapila said about, you know, the star with sort of the B technology or whatever. If you have, we see exceptional technologies that die in the pitch. I mean, I don't know how many founders are in the audience right now, but if you're contemplating going in front of any of the people that you're looking at right now or any other investor, if you're a lousy presenter, if you do not, you can be the most brilliant scientist with the best invention in the last 20 years. It's really, really important to make sure that when you do get up in front of us, that you don't die in that 15 minutes, because you're over as soon as you leave the room and discussion starts if you haven't impressed anybody.
So
Completely agree with Scott.
sure. Let me reverse that a little bit, though. How do you guys, each of you, weed for people like Elizabeth Holmes? right? You're talking about electric founders. You're talking about people who press on the page that you'd rather invest in their C grade or even E grade idea, Z grade idea. But how do you have any methodologies or things that you do to weed for that kind of opportunity, or to weed that opportunity out?
So if there's a CEO who says you cannot meet the rest of my team, who says you cannot walk through my labs, you cannot talk to any of my employees without my being there, I am shocked that anyone missed that. I'm shocked that the board, as a board member, I have access to any and all employees of any of my portfolio companies. And if any of my CEOs tells me you are not allowed to talk to anyone, I'm in there immediately to see what's wrong, because to me, that's a huge red flag.
Anyone else?
I think on our side, for instance, I was looking at a company that did screening for skin cancer, and I think majority of investors that was on the pot on that deal, we decided not to pursue. Basically, the entrepreneur said, we did this AI that will scan for screen for skin cancer, and this model is going to change the world. From my perspective is that I'm an engineer, so when you talk to me about machine learning AI, I want to understand your model. So I sit down and I look at the model, and I think that's probably how the issue with Elizabeth Holmes was, there's no science there.
I mean, and this is fancy a bit, but I mean, the fact is that when Henry Kissinger and the 4-star general show up at your door and say, hey, we're going to make sure that this company gets a lot of government contracts because they're the best and they're amazing, honestly, it's going to be hard for anybody to just look the other way. It doesn't mean that you may not make the final investment, but there is something to be said for having heavy hitters standing behind you. It's hard to say no to that, because you feel like there's a fear of missing out, right? And that's, wisdom and age may help you avoid that, but that's probably where a lot of that came from, I bet.
She was so
speechless right now. So please speak. I can see her like just.
I'll go back to what Scott said and what actually all of them said. Diligence, right? If somebody's preventing you from doing diligence, I don't care if God is standing next to me. Mm-hmm. The reality is that even God has to allow me to do my diligence. And if somebody stops me from doing my full due diligence, that's going to be an issue. Now,
Have you had that opportunity?
Now, I agree that, all of you are investing much earlier than I am, right? Because, you're investing behind concepts. Whereas for me, by the time I come in, I'm actually, in some respects, there's already something there. It's already in the marketplace. There are revenues coming in. So I can diligence with customers who've been using whatever the technology is or whatever the service is. So it's a little different for me, because the kind of diligence that I do, it's not that I will not do the technology diligence, but I will do a lot of the use case diligence.
Okay. So let's go back to Robinhood, actually. I've heard mentioned the statement terms, right? And while I'm sure there's some people in this room who are unfamiliar with the ramifications of that, some people probably are. But in terms of, let's say, Robinhood, who sets the terms? What does that mean, and who sets the terms for Robinhood Ventures or Robinhood Investment?
I mean, it depends on whether we're leading the round or not, as to whether we're negotiating the terms. In an instance where we're leading.
So what is a term first? Go ahead and be my guinea pig and please define it.
Term is the investor's attempt to get as much leverage as possible over the founder.
Well, it's an honest definition. I'll allow it.
It's not particularly malignant, but it's the nature of negotiation. Where I object to, I don't like terms that are the tail wagging the dog, because I find that often people get tied up in trying to establish as protective or defensive a position as they possibly can by virtue of the specific deal terms. And that should never be leading, certainly not in the kind of investing we're doing at an early stage. But terms are simply, what is the valuation that's been set on the company? What are they willing to offer you? If it's a convertible note, is there a conversion preference, which is essentially getting away from all the jargon? I mean, that's a discount on the conversion of the note into equity at the next funding round. There's lots and lots of stuff that I don't want to get into the weeds with here, but I think the bottom line to what you're asking is, if the deal is not in everybody's interest, you're going to be in, founders, you're going to be, the pitching process is a honeymoon. The time you close on the deal, you're going to be involved with these investors for a period of time, maybe on your board, maybe not. For investors, you're going to be involved with this company probably a heck of a lot longer than you'd hope to until you get to an exit. And if it's not right for everybody, if somebody feels significantly taken advantage of or over leveraged or whatever, at least to my mind, that's not a good basis on which to proceed, because it's just going to precipitate tension down the road.
Well, I think the statistic that I read somewhere is that when a founder actually reaches exit, they only own about 15% of their company. Has anybody else heard that that percentage? Is that
in life sciences, it's a lot worse than that.
So my question is if it's not you, then where are those folks losing so much of their company? Or is that not losing? Is that appropriate? What's your thinking on that number?
You directing that to me or to anybody?
I'm actually directing it to anyone. So if you're willing to answer, sure, it's certainly to you, but I'd love to hear from the other folks.
Yeah, I'll just quickly say the old saw is it's better to own a piece of a watermelon than the whole grape.
Anyone else have any pithy sayings?
No, I don't have any pithy sayings, but I can tell you that in our companies, it probably varies. I don't know that 15% is sort of average for our companies. It could be less, it could be more. But I think if you're asking where the shareholder base is, I think it depends on the stage of the company, because it's not just the founder. Sometimes the founder transitions and you bring in what I would call a professionalized CEO to build out the team. The team needs to be rewarded. It's not just the investors. So it's the investors. It's a combination of the seed stage investors, the growth stage investors, the founder, the management team across the board. That's where the ownership gets distributed.
Thank you.
Yeah, I can add something from the entrepreneurial side in raising money a few times, is that where I've seen people go to less than 4 or 5% equity within 3 years because they're really capital intensive businesses, and the time from the initial customer acquisition costs to break even for that individual customer is anywhere from 18 months to 24 months. So the further out that is, the more they have to raise. And, to achieve what you'd call in the Valley escape velocity, you have to raise a lot more money to continue at that growth rate, knowing that you're going to lose money for 18 to 24 months every time you acquire a new customer.
Thank you, David. All right, so we're running down to our last 10 minutes, and I want to ask one more question, maybe open it up to some questions if there are some out in the crowd, which is when somebody approaches you and they speak to you for the first time, what is a good conversation look like, and what does a bad conversation look like? Because we've certainly heard both of those, and we've probably heard a lot more bad conversations than good. And I'm going to bet that the vast majority of the bad conversations sound a lot alike. So who wants to take a good conversation, and who would like to take a bad one? Alberto, you're smiling, so I'm calling on you. Which one do you want?
I think, the way I look at it's structure. We're all saying, passion is important, understanding, what kind of problem you're solving, how big the market is. It's like kind of a given. But if you want to be entrepreneur, at least on my stage where I have to invest, I think structure is very important. Maybe early on, there's not a lot of requirements in terms of, thinking ahead and then structuring things, because you're just really trying to prove
So I'm asking a slightly different question. Let me change the question, because I'd like a different answer, I think, which is, when somebody meets you, what are the things that they say to you that make you take notice? And what are the things that they say to you that make you say, this is not the one?
I would say it's really like structure of speech. Can you elaborate what you're trying to convey, in a structured manner where I can follow your thought process? Then
Thought process, okay.
Then I'm hooked. If you're all over the place and I cannot follow you, then I'm gone.
Anybody else have a different answer? That's a good answer. Anybody? Thorne?
Sure. So, and I'm not sure whether you're talking about in a a networking situation or when they're in the room, and those are sort of different things. But I'd say as a very general comment, you would want for them to be prepared. So if someone came to me and said, "Oh, hey, so what do you like to see in a deal?" or something like that, then we might talk about that, but I would know that that person spent no time preparing to meet me, and everything I invest in and like to invest in is on the website. And Kapila is a theme investor, and if you don't know her themes, then you have no business approaching her with those themes. If, however, you did know those themes and you said, "Gosh, congratulations on the last boom thing that she crushed it on, and I'd be interested in talking to you because I'm doing this," and then don't push it and don't take out your business plan or anything, that would be a much smoother way to show that you knew a little bit about what she's doing. So I would say that that preparation comes through pretty quickly.
Scott or Kapila, anything else to add?
Go ahead, Kapila.
I'll tell you, the one of the worst meetings that I had was, it was an hour-long meeting, and we'd got to minute 40 and I still didn't really understand what the company was doing. That was...
I see a lot of nodding, just so you know.
Yeah.
And one of the best meetings that I've ever sat in on is where the CEO came in with 4 people of his team, or 5 people, I forget, and spoke for 10 minutes and then didn't say another word, and his team delivered. Each of the people in his team had an area of expertise that they were responsible for, and they talked about that. It was great. It was a great conversation.
Did you invest in them?
Actually, yes, I believe we did.
There you go.
It was a while. Yeah, we did, and we had a great outcome. We've sold the company a while ago. It was
Scott?
Yeah, I was going to say the same thing Alberto said in terms of the ability to succinctly articulate what you're talking about, but it's more than that. It's the evidence of command of your of an understanding of your sector, of the specific space you're in, command of the technology, the ability to essentially convince us in a very short period of time that not only do you know what you're talking about, but you know where you're going. In the flip side of that you asked about, there are lots of things that turn us off. I'm certain, this would apply to all of us as investors. But I'll tell you, if somebody gets up and the first word out of their mouth at a pitch is they want to start talking about how quickly they're going to get to their exit, I am tuned out for the duration. It's not that I don't care. I care a whole hell of a lot, but that's not why they're pitching. It's not why I'm sitting there. I want to hear how they're going to get there, not that they have a pie in the sky idea and they want to be out of it in 18 months and make everybody a fortune. That's not an investment thesis.
So there's their turnoff. So Scott's turnoffs include quick discussions about exit. Anyone else have some turnoffs?
We do have a 5-minute warning, just as a heads up.
Oh, okay.
I think maybe we should open it up for questions then, if we only...
All right, well then we can open it up for questions. The silence is deafening.
I'll start with a question. So how does it, being that there's also an engineer / investor on the call, how do you feel about offshore engineering as part of the team, especially when that relates to critical aspects, such as AI and machine learning, when you're considering an investment?
Oh, for anyone?
I think for any of us, yeah.
So as long as you don't outsource the people who set the direction of the technology development, it can work. If you're a non-technical founder and you throw it over the wall, I've seen that backfire really badly. Some of my best companies, though, are outsourcing to multiple different places. They have multiple teams around the world because you can get a really good, rate per hour on some of that stuff. But there's some serious pitfalls to outsourcing tech development, especially if you haven't done it before, especially if you don't have the manager on your side of the pond.
All right. Any other questions?
Yeah, this is Troy. We started out the conversation talking about warm leads and warm introductions into this group. How do you facilitate that if you're on the outside, looking in for these opportunities to get connected with a Robinhood or Slater? What is your recommendation for entrepreneurs to connect with you?
But Thorne.
So you can generate that. So even if you and I did not, go to high school together or something, you can kind of get on LinkedIn. You can see who's on my board. You can see where those people went to high school. You can see what companies they're in, and it spiders out until there's a huge bunch of people. And as a crazy, diligent, do anything to get the meeting entrepreneur, you will find one of those people. Now, you may have to call them. You may have to go to a meeting where they are and saunter up and pretend you didn't know they were there. But one way or another, either by brute force or by force of personality or by the gravitas of your idea, you ought to be able to get to one of the advisors or board members or people in that web that the investor trusts. Or you could just email me.
And Troy Wilford is asking the question. So if Troy Wilford were to send an email that had the name Troy Wilford in it, perhaps one of you guys would recognize that name of Troy Wilford and think, that name sounds familiar. Where do I know Troy Wilford from? And maybe you'd be like, well, I must have met Troy Wilford somewhere, and maybe you'd write him back. So, I'm just stating that as a possibility as well. Troy Wilford.
Expect those emails from Troy Wilford.
Anyone else?
Last
question.
For the panel, hi, Taiwana from the Oravac, part of the Launch Lane. After you go through the process and say you're lucky enough to get to the presentation point, and if the investors are still are looking for something for you to have, how much help will you provide to them? Or is it just get the money and you're done?
Are you more than the money you invest?
That's right. If you're, you get lucky enough, you get the presentation, you're going through the due diligence. Hey, we're going to offer you money, but we'd like to see more of this, or we'd like to see more of that on your team. Do you help, or you just give the check and that's out?
We never give the check and walk away.
Okay.
Ever. It's our money. No, look, you need to come with a coherent plan for what it is that you're pursuing and how you're going to get there and what kind of team you either have or are going to assemble. We want to know how the money is going to be used. And then we want to, be looking, I don't want to say looking over your shoulder, but we want, we need reports on what you're doing. And if we're lead, we might have a board seat where we're sitting with you every quarter. Anybody you get involved in at any point along the process, and anybody else who's on the panel here, should jump in here. Again, this is a relationship, and it's going to be a long-term relationship. And if we don't see the possibility of that working, or you don't see the possibility of that working, you should be looking somewhere else.
Right. I agree with Scott completely. This is a marriage. It's a 5-year, 6-year marriage. You're in it together. And if the chemistry in the room isn't right, you probably don't want that person as an investor or a board member. Because believe me, having a dysfunctional board is one of the worst things you ever want, because it takes away from where you should be focused, which is running your business.
I would say that everybody is busy, and there's probably a spectrum of the people who give a lot of help on one side and not too much help on the other side. If you think you really need a lot of help, it's probably good to be honest up front. If you're talking about how much help you're going to get from your board members or investors, I would say that they're probably really good at help, like, do you know anyone at this huge company that I might be able to talk to? And they're probably less helpful at, can you teach me how to work a spreadsheet? So, you know, different kinds of requests. You want to use them for, you know, Rolodex or CEO advice in a pinch, or hiring things or strategy things, and pick your battles.
Yep. And sometimes open customer doors, things like that. Yeah.
So we are at the end of our time. I would like to thank Kapila, Alberto, Scott, and Thorne for their time and their effort in giving us honest feedback on what it is that goes on in investors' heads. I don't know if there's an opportunity for you to do outreach or connect with them in some other way, but I'm sure that if you go through LinkedIn, you should be able to find them if you have an interest in following up with them. And on behalf of the Science Center and Venture Cafe, who've given us the forum to be able to talk about these sorts of things, I'd like to say thank you. And in conclusion, I'd like to say Troy Wilford.
Thank you, Venture Cafe. This is awesome. We should do more of these.
Yeah.
I actually like this online thing.
I agree. And there's 30 or 40 questions that I didn't get to ask. So, you know, I'm in for another round if people are up for it.
Okay. I'll look for your email, Troy. See you guys.